There is one robotics stock that keeps showing up whenever investors talk about the future of warehouses, automation, and AI-powered supply chains. That stock is Symbotic, ticker symbol SYM. And the big question is simple. Is this actually one of the best robotics stocks to own right now? Or has the market already priced in too much optimism? Because Symbotic has a very interesting setup. The company has a massive backlog, strong revenue growth, improving profitability, billions of dollars in cash, and technology that is already being used by some of the largest companies in the world. But at the same time, this is not a risk-free story. The stock can be volatile. The valuation matters. Execution matters. And customer concentration is still one of the biggest concerns investors need to understand. So in this video, I'm going to break down Symbotic's latest earnings numbers, the bull case, the bear case, and whether I think SYM is worth buying at today's price. Let's get into it. First, let's start with the numbers. Symbotic reported Q2 fiscal 2026 revenue of $676 million. That was above the high end of management's guidance. Systems revenue was $634 million, up 24% year-over-year, and up 8% sequentially. Software revenue was $13 million, up 93% year-over-year. Even excluding a $1 million non-recurring adjustment, software revenue still grew more than 75% year-over-year. Operations services revenue came in at $29 million, slightly down year-over-year because of a tough comparison in training revenue, but up sequentially because of the growth in operational systems. So the top line is strong. But what really caught my attention is that this is not just growth with no profits. Symbotic reported GAAP net income of $9 million. That is a major improvement from a net loss of $10 million in the same quarter last year. Adjusted EBITDA came in at $78 million, more than double the $35 million from Q2 fiscal 2025. That is exactly what you want to see from a growth company. Revenue is growing, margins are expanding, profitability is improving, and the business is starting to show real operating leverage. A lot of robotics companies have exciting technology, but very few are showing this kind of financial execution. That is the first reason I think SYM is a buy right now. The second reason is the backlog. Symbotic ended the quarter with a backlog of $22.7 billion. That is huge. This backlog increased from $22.3 billion last quarter, driven by pricing adjustments and the addition of the first associated wholesale grocers system, offset by revenue recognized during the quarter. To me, this is one of the most important parts of the story. Symbotic is not just hoping customers show up. The demand is already there. The company has a massive backlog that gives investors visibility into future revenue. During the quarter, Symbotic started 14 new system deployments, up from 10 in the previous quarter. That brought the total number of systems in deployment to 70. This tells me that customer adoption is continuing, deployment activity is strong, and the company is scaling. The third reason I like SYM is margin expansion. Management said gross margin expanded both sequentially and year-over-year. That was driven by strong project execution, cost discipline, and scale benefits. This is very important because when a company grows revenue but margins stay flat or decline, investors start to worry. But when revenue grows and margins expand at the same time, that tells you the business model is becoming more efficient. Adjusted EBITDA more than doubled year-over-year. And for Q3 fiscal 2026, management guided revenue between $700 million and $720 million, with adjusted EBITDA between $80 million and $85 million. So they are not saying this quarter was a one-time event. They are guiding for more growth and more profitability. The fourth reason I'm bullish is the balance sheet. Symbotic ended the quarter with $2 billion in cash and cash equivalents. Robotics and automation are capital-intensive industries. Companies need to spend on research and development, manufacturing capacity, suppliers, software, hardware, and acquisitions. Symbotic can do that from a position of strength. The company also generated $218 million of free cash flow during the quarter. That is a very strong number. This means Symbotic is not just burning cash to chase growth. It is generating cash while scaling the business. That gives management flexibility to invest aggressively in the future. Now let's talk about the bigger story. Symbotic is not just trying to be a warehouse robot company. Management described the core system like an operating system, where they can add more applications over time. That is a very important idea. The company is expanding into e-commerce, dock management, route optimization, micro-fulfillment, frozen and perishable goods, and smaller format systems. That means the total addressable market could become much larger than investors originally expected. Symbotic is working on SYM Micro for e-commerce order fulfillment, and management said they remain on track to install the first prototypes this calendar year. They are also investing in next-generation battery technology through NioBolt. According to management, NioBolt batteries could allow bots to travel longer distances, become more reliable, and support larger bots. The company is also deploying larger SYM bots and stretch bots that can handle a wider variety of SKUs. That matters because the more products Symbotic's robots can handle, the more valuable the system becomes to customers. Symbotic also acquired Fox Robotics. This is important because Fox helps with dock automation and autonomous pallet movement. Management talked about connecting more of the end-to-end supply chain. In other words, Symbotic does not just want to automate one part of the warehouse. They want to help automate the movement of goods from the truck to the dock, through the warehouse, and back out for delivery. That is a much bigger vision. And if they execute, Symbotic could become one of the most important robotics companies in supply chain automation. Another bullish point is new customer momentum. During the quarter, Symbotic began its first deployment with Associated Wholesale Grocers, or AWG. AWG is the nation's largest cooperative food wholesaler to independently owned supermarkets. Management said AWG operates over 9 million square feet of warehouse space and distributes to over 3,500 retail locations. Now, management was careful here. They said AWG will likely start with one system and then build one system at a time. But that is still important. One of the biggest concerns around Symbotic has been customer concentration. The market wants to see Symbotic win business beyond its largest customers. AWG is another step in that direction because it shows that Symbotic can continue expanding into new customer relationships and potentially build those relationships over time. The company is also seeing interest from new verticals like consumer packaged goods, food service, apparel, healthcare, auto parts, and potentially international markets. This does not eliminate the customer concentration risk, but it does show that the opportunity is expanding. Now, let's talk about the risks, because SYM is not risk-free. The first major risk is customer concentration. A large portion of Symbotic's business is still tied to its biggest customers. If one major customer slows down deployments, delays projects, changes priorities, or renegotiates terms, Symbotic's growth could be impacted. That is the biggest risk in the stock. The second risk is execution. These are complex robotic systems. Installing large-scale automation inside major distribution centers is not easy. If deployment timelines slip, if costs rise, or if customer acceptance takes longer than expected, revenue timing could shift. The third risk is valuation. SYM is a growth stock, and growth stocks can be volatile. Even when the company reports good numbers, the stock can move sharply if investors worry about margins, backlog conversion, customer concentration, or guidance. So I would not call SYM a safe stock. I would call it a high-upside, high-volatility robotics stock. But for long-term investors who understand the risks, I think the setup is attractive. Here is the bull thesis. Symbotic is growing revenue. Symbotic is profitable on a GAAP basis. Adjusted EBITDA is scaling fast. Free cash flow is strong. The company has $2 billion in cash. It has no debt. It has a $22.7 billion backlog. It started 14 new system deployments in the quarter. It has 70 systems in deployment. It is expanding into software, e-commerce, dock automation, micro-fulfillment, frozen and perishable goods, and next-generation robotics. And it sits directly at the intersection of AI, robotics, warehouse automation, labor efficiency, and supply chain modernization. That is why I think SYM is a buy right now. Not because it is risk-free, not because the stock can only go up, but because the company is executing, the financials are improving, and the long-term opportunity looks massive. For me, the smart way to approach SYM is to build a position gradually. I would not go all in at once because the stock can be volatile. But if you believe AI robotics will transform warehouses and supply chains over the next decade, Symbotic is one of the most direct public market ways to invest in that trend. Let me know what you think. Are you buying SYM, holding it, or staying away because of the risks? And if you want more stock breakdowns like this, like the video, subscribe, and I'll see you in the next one.